For any moves in UK house prices, we see moves in leading indicators. From these leading indicators, we're able to predict price changes in the UK housing market. This was true in 2008 and it's true now. In this video, we're going to track these leading indicators in a spreadsheet to see what's in store for the UK housing market and how that can help us stay one step ahead of the curve. Hello everybody and welcome back. So firstly, we're going to run through our house price indices because of course we always want to be checking back to house prices themselves, because what good is a video series about predicting house prices if we don't come back and refer to house prices themselves? The answer, not very good at all. So let's kick things off. First up then, Rightmove asking prices for December and into January, 362,000 and change. Now that's showing a month-on-month change up 0.9%, and we're still seeing annual change there at 6.3%. Next up, and let's run through this in reverse order, we've got nationwide house prices, which are £258,297. Now that's showing a fall, a month-on-month fall of 0.6%, but still just showing positive annual growth at 1.1%. This has been showing several months in a row of house price declines. Next up then, the so-called official figures, sold prices from HM Land Registry. That's for the period covered to December of 2022, so finishing off last year, 294,000 and change. Now that's showing a fall of 0.4% for the month of December when compared to November, and it's still showing annual percentage change of 9.8%. But for the seasonally adjusted month-on-month move, we just have a look at this figure here, which is produced by the Office of National Statistics, or the ONS, using the same data reported by the Land Registry, just adjusted for seasonality, and that's down 0.2%. Last up then, Halifax reporting for January of 2023, £281,684, showing a small fall of 0.01%, but still showing annual change of 1.90%. Again, similar to nationwide, showing several months of house price falls. Okay, so that's what has happened in reporting house prices from the previous month. Now let's jump into our leading indicator, our dashboard of data that will help us to predict what's going to happen. Next up then, mortgage approvals. Where mortgage approvals go, prices flow. Mortgage approvals are a fantastic leading indicator, and they're an indicator for future lending. So as we've ran through in previous videos, a real tight correlation between mortgage approvals and house prices. Of course, what we can see in this month's move is a huge move to the downside. 35,612 mortgage approvals for the month of December. Mortgage approvals then, as you can see in this column here, are falling off a cliff, down from that November 2020 high of around 107,000. And we can see this a little bit more clearly when we plot mortgage approvals with nationwide house prices. Due to the timely nature of nationwide house prices, we can see that annual change, that's change year over year, is really starting to fall off a cliff. So, put simply, the change in data being down, i.e. mortgage approvals month on month, still continuing to fall and not find a bottom yet, infers that we are expecting further falls in house prices too. Now, who knows where this is going to bottom out? It could be like it was in the 2008-2009 house price crash here, bottoming out in November of 2008 at just 26,000. Bear in mind we're at 35,000 now and falling. So with mortgage approvals, the bears have it this month. That is definitely not the bullish indicator that the bulls were hoping for. If you'd like any more information on that, feel free to sign up to the Property Signals newsletter that I run, where there'll be a link in the description below. Next up then, we're going to move on to wages. So this is total pay seasonally adjusted, and it's the average real, so adjusted for inflation, weekly earnings. And this data set is brought to you by the ONS. And as we've covered before, this graph pretty much plots the story of the UK housing market, that bull run up to the bust in 2008, the subsequent decline, and then the recovery from around 2013 onwards. Pay is important for a number of reasons, but just two reasons specifically. A, because it's savings, and those savings go towards a deposit, and of course you have to borrow against it. Only 8 to 12% of people are cash buyers, meaning everybody else in the market needs leverage, credit, i.e. mortgages. What's the latest reading then from the ONS? We can see this March 2022 high at £528, and we're now down at £503, a fall in real terms of £25 a week. This is what's adding to that real, so in inflation adjusted terms, squeeze on incomes in the UK. And of course, lower affordability, inferring lower house prices. Now, earnings, of course, feed into our next leading indicator, which is real M4 growth. That is the cash, the money that you and I have on deposit in banks or any financial institutions, plus any cash, including notes or coins. For a full definition on M4 and M4 retail, check back to the previous video. We run through it straight from the horse's mouth. In fact, we pick it off the BOE website. And as explained in the last video, we're just going to point out some key historical moments in this top graph. You can see here the back end of the 1989 house price crash. In fact, this next peak is the peak for the 2008 house price crash. And of course, this is where we are now. Whether this is the 2022, 23 or 24 house price crash, it's yet to be named. But the last 3 times, these huge drops in M4 growth have always resulted in house prices correcting or crashing. Now, of course, the saying is, but this time it's different. Well, let's explore that and unpack that slightly in this next graph. Here we've got M4 retail year over year in percentage terms marked in blue, and real, so inflation adjusted nationwide house prices on the right hand axis. And what are we expecting? Well, it should be pretty obvious from the graph. We're expecting this red line to be down nearer the blue line, meaning an adjustment in real house prices. So what are the latest figures for this month? Well, that figure for M4 growth has fallen month on month, so we are expecting a further correction south in house prices. And the M4 retail figure roughly flat, slightly up month on month, but sort of dwindling nowhere at all-time lows, certainly for this data set. So a moderate to severe bear case there, with both indicators pretty much languishing at all-time lows and one pushing further south, indicating future price falls are likely to come because house prices are lagging behind. Remember, M4 moves and then house prices move several or a few months after that. Because these are leading indicators by their very nature, they should move before we see a move in house prices. So let's take a pause there briefly and just have a quick sit rep. We've seen falling mortgage approvals, which is a fantastic indicator for what's likely to happen with house prices in the future. Next up, we've seen falling real average weekly wages, a figure brought to you from the ONS, and then we've just seen real M4 growth continuing to fall, all of which have been historically bearish for the UK housing market. Well, next up, we're going to take a look at rates because that plays into affordability. We're going to take a look at what's more interesting, which I feel is the 5-year mortgage spread. We're then going to jump over and take a look at sentiment because sentiment's a big factor in influencing decisions. We're going to take a look at market inflation expectations, and we're going to do something a little bit different. We're going to take a look at RICS, the RICS Residential Market Report, the survey that's out each month, but we're going to do a deep dive on 2 specific parts. So we're going to jump into mortgage rates, but before we do that, we're going to take a look at real house prices. This is an index produced by Nationwide Building Society, and it's of course real, so inflation adjusted house prices, but house prices adjusted for RPI, not CPI. So in this latest report, we've got the data to complete 2022. We've got Q4 2022, which shows house prices at 265,000 and change. Of course, down quite dramatically from Q1, where we saw house prices at 291,000 and change. So put simply, inflation is outstripping house price growth. On then to rates, and what can we see in the latest data from the Bank of England? Well, we can see yet another month-on-month fall in rates in January. And of course, this will help with affordability, with household affordability. If your mortgage is less, you'll have more disposable income to spend or save. Now, this will be great news for the estimated 1.8 million households coming off a fixed rate mortgage in 2023. And while fixed mortgage rates have come down between 50 and 100 basis points right across the board from that October 2022 high, On a longer term basis, since September 21, they are still up dramatically. Let's go ahead and take a look at the 5-year spread, which is the difference between the UK 5-year government bond yield and the 5-year fixed mortgage rate. Well, the month-on-month move for January is that the spread has increased ever so slightly, but we're more interested in this historical, slightly longer term look down from that bottom in October of 21 at 0.47. Just to reiterate, a rising spread showing increasing levels of risk in the UK housing market, whereas a declining spread shows the exact opposite. And we can demonstrate this. If we take a look at the spread here, peaking out in July 2012, that was when the spread started to decline. And so why was this significant? Well, what was going on in the housing market around the same time? If we look back at real house prices, again, house prices adjusted for inflation, we can see this bottoming out here in Q4 of 2012. So as we've said before, it wasn't until we saw a decline in this spread from this period here to this period here, or even here, that we began to see real, so inflation adjusted growth in the UK housing market. So in short, the spread is an excellent way of isolating risk, and a rising spread means rising risk. So here we are at the GfK Consumer Confidence Barometer, which is research carried out by, of course, GfK, and this research is used by government themselves. You can see here this historical low, which was actually one of the lowest readings, or the lowest reading that they'd had since the series started in 1974, I think. Now we are ever so slightly up off those really low lows, but still languishing at all-time historical low levels. Lastly, then, we're going to take a look at the last slide, which we're going to look at is the economic situation in general over the next 12 months, so forecast forward. Well, again, similar thing to the previous graph, we're seeing this all-time low here, but we are bounced slightly off that for January of 2023. So, to recap and to conclude sentiment, whilst we are still down at these very, very low historical levels, we have bounced off the worst reading yet. But just to reiterate why this is such a good gauge of consumer confidence, if we take a look at the 2008 blow up, we can see both of these indices peaking way before house prices. In fact, house prices bottoming in March of 2009. Well, this was bottoming, in around the summer of 2008. Okay, we're going to leave the UK confidence barometer there for a minute, and we're going to jump into the UK residential market survey by RICS, the Royal Institute of Chartered Surveyors. And we're going to take a look at the January data published in February. Well, the big headline, sales volumes and prices continue to retreat across the housing market. Underneath that, metrics on buyer inquiries, agreed sales and new instructions all remain negative. House prices continue to slip at the national level. Forward-looking indicators still point to a subdued outlook for the market. So the two key readings that we take are the net balance for new buyer inquiries, which you can see here, and that slipped to minus 47, down from a reading of minus 40 last month. The second thing I like to pull out is the volume of fresh listings coming onto the sales market, and we've got a net balance reading here of minus 14. Now, anyone who's been watching the video series from the start, know we don't just take one headline for demand or one headline for supply and run with it. We have to look at both supply and demand. But more interestingly, we've always talked about it in terms of a ratio, the ratio between demand and the ratio between supply. And the reason we do that is simple. Let's say new buyer inquiries, which we'll take for demand as dropping. Let's say we assign it a unit of 10. I'm not saying there's 10 buyers. We're just going to assign it a unit of 10. And we apply a unit of 10 to new listings, which we're going to take as supply. Now, if demand falls from 10 to 5, but also supply falls from 10 to 5, both readings now being 5, there's been no change in that ratio. The difference between 5 and 5 is obviously nothing. Now let's reset both of those back to 10 and give another example. Let's now say new buyer demand went from 10 to 12, but new listings, i.e. supply, went from 10 to 8. So demand at 12, supply at 8. Now that would give us a ratio or a difference between 12 and 8, which is 4. Now, if we could track this ratio, it would be interesting as it would tell us where the spread or the skew is coming from. Is it coming from the demand side? Is it coming from the supply side? Or is there no change in that ratio? Okay, all stuff I've said in previous videos, but one thing I want to show you now, if we go back to the spreadsheet, is something new. Okay, we're back in the spreadsheet and we've been talking about this for months, so it's about time we get this down in black and white. So we've got new buyer inquiries in column B and we've got new vendor instructions in column C. And I must add, painstakingly dragged out from each report, as unfortunately RICS don't give us access to the raw data. So I've gone through each report, dragged this out, the data from the two relevant columns for each report going back 2 years. So new buyer inquiries and new vendor instructions, that's what we're looking at. But why are we looking at those and how are they calculated? Well, just a little bit of a reminder about the methodology. These are net balance. So new buyer inquiries on net balance. So everybody that's reported a rise in new buyer inquiries minus everybody that's reported a fall in new buyer inquiries. And the same is true for new vendor instructions. So just to give an example, if 30% reported a rise and 5% reported a fall, the net balance would be, of course, 5 from 30, 25. So that's the first point to recap on how this data is derived. The second point is, why would we use new buyer inquiries and new vendor instructions? Could something like appraisals be a better, more timely indicator of future supply? And there's no right or wrong answer here. Yes, absolutely it could be. There's no hard and fast rules. The other reason is new vendor instructions versus new buyer inquiries are the two most timely-ish metrics that we can use in comparison to each other versus, say, using total supply or the amount of properties that are on agents' books. For me, simply taking new inquiries and new instructions and comparing those was the fairest way to get a gauge for supply and demand in the market. Certainly, new supply and demand. Now, whilst of course we are interested in the headline figures for new buyer inquiries and new vendor instructions, or what we'll call new demand and new supply, we're more interested in the relationship between the two, or that difference. And if we graph this out, it should be easy to see the difference highlighted between the blue lines and the red lines. So let's unpack this a little bit and see exactly what's been going on, as this tells the story of the last 2 years in the UK housing market pretty accurately. So let's take this from January 2020. Very, very, very tight, arguably no difference or very little difference in between supply and demand as shown by RICS. That is until we get to around June of 2020. At this point, demand starts to pull away from supply. We then see a fall, but in both of the figures, in both of these metrics that we're tracking, all the way down to Jan 2021, wherein we see another possibly seasonal jump in both indices. And it's from Jan 21 onwards, really getting going after March 2021, where we see this supply demand imbalance continue to grow on the demand side. So what we're saying here is that new buyer demand was increasing at a faster rate than new supply, i.e. demand was greater than supply. And of course, what did we see? Well, it's exactly what we saw in prices. We saw an increase in house prices throughout this period. In effect, demand was outstripping supply. But that all came ahead after this. So demand, the blue line, remained elevated, pulling away from supply all the way until here, where we have something which I'll call a death cross. And so what happened here? Well, new vendor instructions began to increase and buyer demand began to fall. But to state the obvious, both are continuing to fall. This blue line here declining all the way down to a reading of -47, and this red line declining from a peak here of 8 to -14, although not falling by as much as the blue line. But it's not so much what we're interested in. It's this spread, remember? The spread or the ratio, the difference between the two relative to one another. Well, so what? Tell me something in terms of prices. Well, absolutely. The death cross happened in April to May time, and of course in two of the house price indices, both Nationwide and Halifax, we saw a peaking out in prices in August of 2022, a few months later. So tying in with all the other information, our other leading indicators that we had, when we saw this death cross, this unwind of this ratio here, which led to house prices actually increasing, after that it was screaming that house prices would likely soften. So this is a very easy but powerful way to predict moves in house prices by looking at supply and demand. And in fact, if we took column D and we took new vendor instructions and minus them from new buyer inquiries, we could actually plot the spread. And anybody on my Property Signals newsletter, I'll do that because it's actually much easier to read with readings being positive and also negative where we expect further or future price falls. So what would happen in the spread if we were going to see future price falls? Well, we'd probably see an increase in the spread. So new vendor instructions going up faster than a rate of new buyer inquiries. So that spread between the two increasing. Okay, what would we see if we were likely to see price rises in the spread? Well, exactly what we've seen before in 2021 and throughout the first half of 2022. We'd see new buyer inquiries outstripping new vendor instructions, demand being higher than supply. So I think this is a fantastic indicator for future price moves, and it should stay on our dashboard of leading indicators. Now that took quite a long time to dig out, clean up and graph, but I think it fully deserves to be on our dashboard of leading indicators. It only gives us time for one more thing. That's inflation expectations. And the reason we're going to look at that is simple. The reason the Bank of England are hiking bank rate is to combat inflation. Of course, if we can predict what market expectations are going to be for inflation, we may well be able to see ahead of time the response the Bank of England takes to curb inflation, whether that's interest rates up or down. But these are expectations not from me, not from you, not from the Sunday Times, not from Bloomberg, not from anybody. These are market expectations for inflation. So this is a good way for anybody umming or ahhing, thinking whether the BOE will increase bank rate or in fact drop bank rate this year, while the market curve actually, compared to back end of last year, when we were looking in our videos, October, November, December, there's been a marked change in the front end. This here, if you can see on the screen where I'm hovering around my mouse, the front end, 0 to 5 years, there's been a dramatic change in that. It's come down a lot. And so does this fit our bias? Well, it does, because in October we saw a CPIH rate of 9.6%, whereas in January it was recorded at 8.8. So inflation has come off. So whilst it is predicted to remain sticky, it is expected to certainly fall over 2023 and into 2024. And so rate hikes in bank rates still expected, but not expected to be as severe as was in 2022. And with that, we're out of time, guys. Thank you so much for watching, and I'll see you next month.